For this week's presentation topic, we are going to discuss the never-ending debate about financial disclosures. Is there a need for more financial disclosures to promote transparency, or is a lot of disclosure just a wastage of time and resources? Let's look into it. We will start a discussion by looking at some negative consequences that might arise when regulators mandate too little financial disclosure. Very less financial disclosure can lead to issues such as the lack of transparency, uncertainty, and false window dressing. Lack of transparency. If the financial statements do not provide complete disclosure, then that can mislead the readers of financial statements and hamper their decision making processes, which would be based on those statements. This will also lead to a decreased investor trust as they might think that the company has something to hide. Managers and employees are directly responsible for the performance of the company, and if the financial statements are lacking, they cannot really know the result of their efforts. Tax authorities and other regulators might be doubtful about the working of the company as well. As can be seen in this illustration by the Australian Securities and Investment Commission, investors who read the information document made better decisions as compared to the ones who just read the summary prospectus. 34% of the investors who read KID invested all their money in the best one, while that number was 24% for investors who read just the summary. Uncertainty. If the financial statements are detailed, then the stakeholders and consumers can ascertain the true performance of the company. Therefore, there are no shocks. Market volatility means big swings in stock prices over a specified period of time. Incomplete or less disclosure can lead to market volatility and thus economic crisis. The GFC is an example of this volatility caused by shocks. Insider trading. Finally, the undisclosed information can be used for personal gain, which is also called insider trading. As can be seen on the two news reports on the bottom of the slide, the practice of insider trading is common and can thus promote speculation and distrust.
Now that you've heard about what happens with too little disclosure, let me share with you the negative consequences of too much financial disclosure. In general, it's usually never a bad thing to present relevant financial figures to the general public so investors can make a well-rounded decision on their investment towards the company. However, when we're looking at the negative consequences of too much disclosure, the two things that come to mind is information overload for investors and the loss in competitive edge. Alright, so information overload. What do I mean by this? Well, by definition, this happens when too much information is provided to someone at one time, causing them to feel overwhelmed and unable to properly process said information. When referring to financial disclosures, however, this concept refers to how financial terms and acronyms may be common to a regular financial investor, but for new investors who are unfamiliar with them, they may struggle with the heavy usage of such terminology and become overwhelmed. Accompany the complicated financial jargon with an extremely lengthy oversell of disclosed information, and you have a formula that may not only turn away new investors, but also hinder their judgment. Based on a past study in 2021, the graph below shows a steady increase in the length of disclosures released per year, which shows that with new standards, disclosures are only getting lengthier and lengthier, causing potentially more issues for investors. This overload of information is a real-life example of the saying, more is less, where too much financial disclosure may hurt them more than help them. Another negative consequence for the company is the increase in competition amongst firms. I say this as in 1998, the FASB adopted Statement Number 131, which lays out new regulations for firms to abide by when disclosing their financial information. This was to further inform and protect investors. However, this was a major change from before, as previously large companies would be able to disclose their information with some level of flexibility and discretion, sometimes even being able to report all their business segments in one singular generic report and then chalking it up to proprietary information. This allowed major successful firms to maintain a strong competitive edge over the competition. Unfortunately for them, as discovered in a 2018 study by UConn accounting professor on 138 firms, the firms that were required to disclose more information and alter their segment reporting saw a decrease in operating performance. Furthermore, those firms saw an increase in expenses that point towards a sudden push in effort to maintain their market share in an increasingly competitive market. Hence, this study showed that too much financial disclosure could hurt a company's edge, as not only investors but the company's competition is able to gain more in-depth access to their financial information. Overall, I believe that from an investor's point of view, over-disclosing is definitely better than under-disclosing, as the former allows experienced investors to make more sound investment decisions as compared to before, with majority of the negative consequences of too much financial disclosure falling mainly on the companies instead.
From now, we will discuss whether stock market investors prefer mandatory disclosure or not. So basically, in accounting terms, mandatory disclosure refers to a set of rules that state which information should be recorded as a transaction and which information should not be a part of the accounting system. The claim that mandatory disclosure rules encourage investor participation in the securities markets is based on the fact that such rules level the playing field between individual investors and more sophisticated retail investors. It is believed that mandatory disclosure increases investor participation due to the two following reasons. Firstly, because investors are more likely to participate in a market when they know more about a firm. Securities disclosure are a way to ensure that individuals get information about such public firms dealing in the market. Although institutional investors and high net worth individuals already have access to such information from internal sources, this information may provide a particular benefit to the individual investors and maybe not to the large retail investors. Secondly, previous work has shown that individual investors are more likely to participate in the market when they are assured that they have equal access to the information as other market participants. The reason is based on the fact that if a more informed investor is willing to buy or sell a security at a given price, a relatively uninformed buyer or a seller taking the other side of the trade in that kind of a situation can rationally conclude that the price he or she is paying for the security may be a losing proposition. As you can see from the graphs presented above, previously conducted surveys suggest that individual investors prefer firms to disclose more material information that enable them to make their investment decisions. This claim has been hotly debated for decades, with commentators emphasizing on two objections. Observers dispute whether individual investors should be encouraged to participate in equities markets at all. Some have argued forcefully that social welfare might be enhanced by excluding or at least discouraging individual investors from participating in stock markets. Moreover, recent work, however, has argued that modern securities filings include such an overwhelming amount of information that mandating more disclosure is unlikely to encourage investors to invest. Instead, under this competing view, individual investors are likely to be overwhelmed by the volume of information that is available to them in the market through these modern securities disclosure, and thus will not use such information in making their investment decisions. Despite these arguments, however, securities regulators today emphasize individual investor participation as important as policy objective of modern securities law.
Now we'll move on to discussing the mandate of financial disclosure from the perspective of corporate managers. To start, what is the role of corporate managers? One of the main responsibilities of a corporate manager is to report the company's financial performance while complying with the relevant financial standards and rules of disclosure. Secondly, a corporate manager must monitor the company's operations and ensure that things are running smoothly and ethically. Thirdly, corporate managers are also required to maintain relationships with stakeholders such as investors. Their ultimate goal must be to take actions to maximize shareholder value. Mandatory disclosure affects the way financial reports are constructed, which operations are monitored and how, as well as the information disclosed to investors. Now, let's think about why corporate managers will prefer more mandatory disclosure. One reason would be that mandatory disclosure helps develop corporate governance by building greater transparency and thereby reflecting a truer value of the business. This can build trust with investors and a sense of credibility of the firm. Next, investors are more willing to invest in the business because of a better and more transparent relationship with the company. This also happens through the reduction in the asymmetry in information between investors and companies, which is what often leads to insider trading. This, therefore, helps corporate managers to achieve their goal of maximizing shareholder value. However, there are several reasons why corporate managers will not prefer more mandatory disclosure. First is that more mandatory disclosure means more costs and more time dedicated to complying with it. This is expensive in terms of, for example, cash paid for expensive auditing fees, as well as the opportunity costs of time spent on it. Next, many financial disclosures are suited to specific types of companies, such as some may be more suited to small businesses, whereas others more towards larger businesses. The inappropriateness of mandatory disclosure might lead to companies competing based on it, which is difficult for corporate managers to deal with. And lastly, mandatory disclosure puts a lot of pressure on corporate managers and their teams to meet stricter financial standards. To avoid this pressure, managers may lean towards exiting the company's market listing itself, removing the source of the majority of mandatory disclosures. This may not be in the best interest of the managers or the company as a whole.
As we all know, transparency is a vital part of any healthily functioning entity in our modern society. But what exactly is corporate transparency, and why is it important when dealing with financial disclosures? Well, corporate transparency refers to the degree to which a corporation's actions are observable to the public. Key tenets of corporate transparency include the need for public observability, holding entities accountable, and helping clarify corporations' role. Corporate transparency is vital because it protects shareholders' interests, prevents illicit enrichment, and prevents malpractices regarding financial reporting and disclosure. Now that we have a better understanding of the need for corporate transparency, let us examine alternate ways in which corporations can improve their transparency. Despite the presence of extensive legislative and professional standards, certain deficiencies still exist and, as such, could be remedied using alternative methods to improve transparency. The first alternative method is using summarized and digestible breakdowns of financial reports. Financial statements are comprehensive and can be complex to understand for certain shareholders. As such, accounting firms could create summarized and easily understandable breakdowns and notes of the financials. These would idealistically be publicly available and easily accessible. Next, another effective method to improve transparency could be through presenting financials through a seminar-style presentation of financials. As per the CFA Institute report on financial reporting disclosures, as seen in the slide, a survey conducted on 300 shareholders saw that 85% of shareholders prefer statements and statement presentations over disclosure framework. As such, under this method, certain shareholders would be invited, either face-to-face or online, where a presenter from the corporation would give a seminar presentation on the financials and allow the shareholders to ask questions to help clarify their questions. Finally, the alternative method of transparency reporting is a substantially beneficial method to help improve corporate transparency. Transparency reporting entails compiling a report alongside financial statements, which breaks down the firm's practices and methods, as well as the key goals. This method goes beyond AASB and legislative requirements by promoting and ingraining corporate social responsibility within the internal work culture. This method can be seen in the practices when examining KPMG. KPMG is an accounting firm which conducts extensive annual transparency report dealings. Finally, despite these alternative methods of improving corporate transparency, there may be significant practical limitations and impacts. Firstly, these alternatives can be difficult for small to medium enterprises to adopt, as they are costly and consume many resources. This is only compounded by the notion that, as per the Association of Chartered Certified Accountants, 95% of accounting firms in Australia are SMEs. Furthermore, these alternatives are independent of political and legal influences associated with legislative standards, but in turn are not directly enforceable by the law, and as such are heavily dependent on the internal autonomy of the firm itself. Conclusively, taxation is a multifaceted area of accounting, and financial disclosure is a complex facet of this area. There are several considerations, such as negative consequences of excessive or minimal financial disclosure, whether stock investors prefer mandatory disclosure, among other considerations. Despite the existence of various alternatives to promote corporate transparency, it is also vital to acknowledge the impact and limitations of such policies when in practice. Thank you.